Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Lisa Littman. She's a licensed real estate broker with Brown Harris Stevens to discuss fueling a two-step housing market recovery in New York City. Lisa, it's great to have you with us. Thanks so much for joining us on Trade Talks. And of course, New York City, which is such a big contribution to our GDP and our national economy. What happens in New York City really does matter. Of the different financial crises that you have been through in your career, is this the worst you have ever seen? Is this comparable to 2008, 2009?
Yeah, I mean, I would have to say that so far, this seems like the worst. It's hard to say because the economy is not really open. At least our part of the economy is not open. You know, we're not allowed to show apartments now. So while there's some transactions taking place, they're few and far between. It's down by 90%. I have worked through 9/11, and I worked through the Wall Street meltdown, the financial meltdown of 08, 09. My sense is that this is going to be worse because it's a health pandemic that's also affected the economy globally. So we're going to have, the emotional component that we had with 9/11, and we're also going to have the economic component that we had with the 2008, 2009 meltdown. And, those two events were not certainly 9/11, but 08, 09, a little bit more Wall Street and New York focused. This is global. And so in my mind that this is going to be more severe.
And pent-up buyer demand and a 49-year record low mortgage, do you think that could fuel what you're calling a two-step market recovery in New York?
Well, I think that, I made some of those comments about a month and a half ago. Some of what I think has probably the timeline has extended out. People do realize that the interest rates are at all-time lows. They're not going to stay there forever. My sense is that the first few months that were allowed out there, meaning, New York City opens up for certain businesses, specifically real estate, obviously, is what we're talking about. I'm not allowed to show now, but hopefully within the next month, we are allowed to show. I think the first few months of that are going to be slow. I think emotionally and psychologically, it's going to take some time for people to sort of physically and mentally get out there. They're going to have to get used to seeing other people in person. They're going to have to get used to being close to people, walking into other people's homes, using public transportation, getting into taxis, Ubers, those kinds of things. That's going to take some time. We've been quarantined for a long time, and human nature is that we don't just change things exactly overnight. So I do think the first few months are going to be slow going. There will be some transactions. It's going to be both from pent-up demand and also by force of necessity. There are going to be some sellers who have to sell their properties, and there are going to be buyers who really need to buy. They may have sold what they were selling already, and they need a place to live. They may have to get out of their rental. They may feel really cramped, especially from being quarantined in a small place for a while. So we will see some transactions. I do think that it's going to be slower paced than it was pre-COVID. And I think that the prices will probably be down from pre-COVID, the first few months.
Let's talk about the two steps within the process.
Mm-hmm. Okay, so that's the first step. The first step is going to be people getting out there. The first step is going to be going to see apartments again, meeting with people again, taking public transportation to get there, Ubers, taxis, and being comfortable in somebody else's apartment. I'm sure the first step is going to be with masks, with gloves, softly, slowly, with trepidation. That's the first step.
And then the second step, you had spoken about that a bit before in terms of when the rebound may occur, but you also mentioned that the under $2 million segment could be the most affected.
Well, my sense is that the higher the market price, the less it's going to be affected by the pandemic. Reason being is the people at the highest level, the stock market's still okay, and they won't have lost their jobs. So the higher the priced home property will probably be, the buyer pool will not be as affected. That's number one. The lower price point, under $2 million, may be more affected because more of those people may have lost their jobs or been furloughed, and or the portion of money that they have in the stock market is a much larger portion of their overall net worth. And if it's gone down by a third, that's going to be more palpable. Now, the stock market seems to have leveled, doesn't seem to be going down too much anymore. Hard to know if that's going to stay the same. There's been a lot of news in the last 2 weeks about the stock market not being reflective of Main Street. I think that is definitely something that has happened in the last 5 to 10 years. We already saw it actually before the stock market plunge in March and the COVID epidemic. The last few years, obviously, the stock market has been at record highs, and our real estate market has already been softening since 2017. So even before that, we saw sort of a disconnect between Wall Street and Main Street.
So going forward, and you said some people are going to be forced to sell, not that you want to profit on someone else's misfortunes, but it sounds like this could potentially be a buyer's market unless everyone's kind of running for the hills and looking to leave the cities or go to the suburbs. So is this an opportunity for buyers?
I actually think it's a great opportunity for buyers. I think it's certainly going to be a buyer's market. I see this correction as potentially be allowing some buyers who've been on the sidelines for years to be able to buy again. And if you think about it, I went into the business in 97. Since 97, the real estate market has basically quadrupled. Prices have quadrupled. People's incomes have not quadrupled. Now, the interest rates have gone down. So perhaps you see it as maybe the buying power hasn't quite lost 3/4, but it probably lost at least 50%. So that put a lot of people on the sidelines. And I think some of those people are going to be able to start coming back in. If our prices go down another 10 to 20% where they were pre-COVID, that's going to make a lot of stuff. That's going to make things more affordable for a lot of buyers who are on the sidelines. And I think that may happen. So we may see a little bit of a switching of buyers and buyers. There may be some people who were going to buy and are now fleeing for the hills, as you said, or go to Westchester or something like that. But I think we're going to see new people coming in who have felt priced out of Manhattan and now will be able to afford what they wanted.
All right, Lisa, thank you so much for joining us on Trade Talks.
Okay, thanks. Have a great day and stay safe.
Thank you. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.